Well, it's apparent Santa Claus missed his appointment for the stock market and he's running a little bit late. But the Santa Claus rally is still coming. I think the Santa Claus rally is actually starting today, but also we're going to see this running into the new year and throughout the whole month of January. There's something called the January effect, and we're going to go over that a little bit, but I also want to talk about the Santa Claus rally just in general, what exactly this means, as well as the wash sale rule and how we are setting up with AMC, literally in a technical breakout as we currently speak, with this CCC line, this yellow line above the blue line for the first time since late November. A lot of other things to get into here in this video. If you guys are holding on to your shares, if you're excited about this potential end of the year rally into the first month of next year, if you're holding your shares, if you haven't sold any, hit the like button for me, consider subscribing to the channel, and let's get into this video. So, Santa Claus's big ass missed his appointment. That's obvious. He's a little bit late this year, but give him credit. It looks like he's still coming. Now, as far as what the actual Santa Claus rally is, if you guys are unaware of what this is, we're going to briefly read this paragraph so you get the scoop. A Santa Claus rally describes a sustained increase in the stock market that occurs in the last week of December through the first 2 trading days in January. There are numerous explanations for the cause of a Santa Claus rally, including tax considerations, a general feeling of optimism and happiness on Wall Street, and the investing of holiday bonuses. Another theory is that some very large institutional investors, a number of which are more sophisticated and pessimistic, tend to go on vacation at this time, leaving the market to retail investors who tend to be more bullish. We're not seeing that. We're not seeing institutional investors, by and large, going on vacation. Still, the markets have incredibly high volume, and we're seeing incredibly high volatility. But especially over the next 2 trading days, Wednesday and Thursday, you're going to see more of these institutional investors back away from the marketplace. Less shorting is going to be happening, and you're going to see retail investors somewhat take over. And specifically for AMC stock, that is going to be key as we did just enter into this technical breakout. That leads us into the January effect. The January effect is a hypothesis that there is a seasonal anomaly in the financial market where securities prices increase in the month of January more than in any other month. As you guys can see right here, incredible returns in the first month or first really 3 months of the year, as really investors are trying to figure out and set their bets on what is going to do well throughout the rest of the year. The key takeaways of this: the January effect is the perceived seasonal tendency for stocks to rise in that month. Since 1938, 29 out of 30 years of gains seen in January to February resulted in average yearly S&P 500 advance of 20%. So obviously the data does support this. And what is specifically happening this year is that the large cap stocks, like I've said many times, they're up almost at all-time highs. So if you're looking for those returns, and specifically in this year where hedge funds have to impress their clients because they're trying to keep their capital for a longer period of time, you have to branch out into these mid-cap stocks that are down on average 28 to 38% from their 52-week highs. Your mid-cap stocks: AMC also a recovery stock. A lot of people are talking about potentially the end of the pandemic, the end of coronavirus in general. AMC is a key beneficiary of that kind of sentiment, as well as the high short interest they do have. We could essentially be looking at hedge funds buying the stock to short out or squeeze out other hedge funds that are short on the stock, because logically speaking, you'd rather invest with a group of retail investors that are literally holding onto the stock. That is the whole purpose of this stock, is to hold on to it. You'd much rather take that side of the bet than going with the other hedge funds and short the stock, especially when the business is doing much better now and there's really not a short thesis left on AMC. But how does this all tie in? That is going to be tax loss harvesting. Now, this is pretty straightforward and simple. For the average person, every situation is a little bit different, but you can write off $3,000 of losses to offset your capital gains for the year. And it's no surprise, the markets are up a lot, hedge funds are up a lot, mostly everybody is up a lot. S&P was up about 25%. might have fluctuated a little bit, but that was only just a couple of days ago. So people have a lot of gains. And when you do sell those stocks, even though you're still bullish on those stocks and you still want to own those stocks that you are down on, like PayPal, AMC, SoFi, DraftKings, investors want to own these companies, or Square, or Tesla even. People want to own these companies. But if you sell them to write that off and take the loss against your capital gains, you have to wait 31 days. That is known as the wash sale rule. And it states that if an investment is sold at a loss, then repurchased within 30 days, the initial loss cannot be claimed for tax purposes. In order to comply with the wash sale rule, investors must therefore wait at least 31 days before repurchasing the same investment. So this is all coming at a pretty obvious time. We've seen a major sell-off throughout the second half of November through really up until now, first half of December. So that 30-day period was really bad. After really the next 30 days or so, you're going to see investors piling back into these stocks, and AMC is going to be, like I said, a prime beneficiary of this, because you not only have a business that is improving with a retail backing of investors, you also have the short squeeze that is on the table. And these institutional investors, they know and have more data than we do. They might know how many synthetic shares are outstanding. They might know what their counterparties, their rivals, right, their competition is doing with the option chain to cover and hide the short interest. So it's pretty clear to see, like I said, at this current moment, what is going to happen and why Santa Claus is just a little bit late to the party, but he is most certainly coming. Might be in the new year where we see most of the gains, but typically the Santa Claus rally doesn't even start on paper, right, until December 24th, the day before Christmas. Some people argue it happens the week before Christmas, but we didn't quite see that per se. Now, a couple of other things that I do want to go over here in this video is going to be some of the data around this breakout, and just go over the short interest really quick in the option chain. So let's do this pretty fast. So for the day, let's go ahead and refresh this. We have, let's wait for it to refresh. We have 20.28% short interest of free float, 104.1 million shares that are sold short, share utilization at 81.34%, and then the days to cover at 2.46. This is exactly what I want to see, is the days to cover hit that bottom and is now going up again as the share price is also going up. We want the stock to go up as much as possible before the days to cover starts to go down. So right here, this correlation is looking incredibly bullish. Eventually days to cover will shoot down and the stock price will shoot up to that $50, $60, or $70 price range. And that is just a given fact. That's the correlation that we have seen. If you guys have not heard me talk about this, then definitely go check out some of the other videos to get the full scoop on what this correlation exactly means. Now, as far as this whole video that we're talking about, this December price action and January price action that we're going to see, it's very important to take note of January 21st, 2022. We already have 129,000 calls that are in the money. That controls about 12.9 million shares that have to be bought if AMC stays at the current price. 411,000 calls that are out of the money. We don't really have to focus on the put side of this, because the puts that are out of the money are very far out of the money, and then the puts that are in the money, it's only 35,000, and I think a lot of those will actually go out of the money. So this can cause a little bit of buying power, but nothing even close to the side of the calls, or the call side of the option chain. And if we actually do go ahead and take a look at the actual option chain, we can see, and you guys might have seen this already or heard me talk about this, but we do have 10,500 for open interest at the $35 strike, and then the $40 strike, we have 55,000 for open interest. This is some of the highest numbers on a single strike that we have seen in a very long time, and I do expect to breach above $40 by January 21st, 2022, and that's going to give us a big boost up to the 45, which we do have more high short interest, or open interest on the option chain, and then at the $50 strike as well, and then ultimately the $60 through the $75 strike is also very high. Now, the last thing that we must talk about here in this video, which is the technical breakout. This is something I hope you guys pay very close attention to. The yellow line just crossed above the blue line, and even take it to back back here when we did go to about $26 per share on the low end, bounce back up to about $34 per share. This whole time on the CCC line, and well, this yellow line and the blue line, we had a severe gap here, meaning we were very bullish this whole time. And even as we were coming up and seeing that wide, almost $10 fluctuation from the bottom to the top, we didn't even go close to going bullish on the MACD. And this is a main component of trading algorithms, basically software, and how they trade stocks and find these arbitrage opportunities. So you didn't really see that effect start to kick in. And I do think now that we are actually going substantially bullish, if we do zoom in, this gap is starting to widen to the upside. You're going to see these trading algorithms really start to buy the stock. And we are seeing low volume today of only 34 million. And we are seeing a price increase anywhere on the day between 3% and then 7% at the high end. That's very good. You want to see low volume and a big price action move to the upside, because think about it, when you start to get 100, 200, 300 million for volume, if you're seeing 34 million in volume push the stock up, say 5%, imagine what 100, 200, or 300 million is for volume is going to do to the stock. You're looking at 10, 15, 20, 30, 40% increases on any given day. And that is really due to people that are holding on to their shares. Ultimately, once we break out past the 200-day moving average, my price prediction by the end of the week was to close in between this 200-day moving average and $35 per share in this range right here. We'll see if that comes true. It's looking like it likely will. If we can break out past this 200-day moving average at $32.45 per share and past 35 and ultimately the 50 and the 100-day moving averages, we're clear to go to $45, $50, $60 per share. And I think that is most certainly happening in the month of January. So that is basically going to conclude this video. If you guys found value out of it, or if you want to share this video, make sure to do that. Make sure to hit the like button for me. Consider subscribing to the channel as well. Check out the pinned comment down below. Go ahead, follow me over on Twitter, as well as check out the link for the buy and sell alerts. Also, links for free stock down below in the description. It's never a bad idea to have multiple different trading brokerages and to get some free money nevertheless. So love and appreciate you guys. Thanks for watching this video. I will see you in the next one.